推荐资本本期视频为您带来的是摩根士丹利在4月16日闭门会聊关税对汽车行业的影响。全球汽车行业正被卷入一场前所未有的关税风暴眼。当美国突然对进口汽车和零部件加征 25% 关税，整个产业链瞬间进入生死时速。欧洲豪华车巨头首当其冲，宝马奔驰的利润率可能被砍掉2个百分点，大众集团被迫暂停墨西哥工厂出口，保时捷甚至考虑在美国本土建厂求生。这场关税冲击波正以惊人的速度改写全球汽车版图。美国本土车企看似受益，实则暗藏杀机。通用福特每卖一辆进口车就要多掏5125美元关税成本，这相当于直接吞噬他们 88% 的年度利润。中国车企却在这场混战中意外获得喘息机会。比亚迪等品牌凭借3年前布局的海外工厂网络，成功避开关税锋芒，正以每天600辆的速度蚕食全球市场。供应链地震正在引发多米诺效应。日本二线车企马自达、斯巴鲁因本土化率不足，面临利润归零的致命威胁，而丰田本田却凭借 80% 的美国本地产能成为乱世赢家。更令人警惕的是，这场危机正在重塑全球投资逻辑。米其林、沃尔沃卡车等关税避风港股票异军突起，而印度汽车零部件三巨头 Motherson、Borderforge 的盈利可能蒸发 30%， 高杠杆供应商随时可能成为第一块倒下的多米诺骨牌。当我们把镜头转向南美，巴西供应商 IoT Pimaxian 的美国订单正以 6% 的速度流失，而专注本土市场的 Randon 却逆势飘红。这场关税博弈最危险的定时炸弹藏在第二季度财报。美国卡车制造商订单量断崖式下跌，车企不得不将全年盈利预期推迟到2026年。更致命的是，5月3日这个关键节点正在逼近，美国政府即将公布豁免清单，这个决定可能让车企的关税账单瞬间减少100亿美元，也可能将整个行业推入深度衰退。此时此刻，租车巨头赫兹和安飞士却悄然布局，他们价值270亿美元的车队正在等待二手车价格暴涨 11% 的套利机会。当全球车企在关税迷宫中艰难寻路时，中国军团已悄然完成对东南亚、东欧和拉美市场的合围。这一场汽车世界大战才刚刚拉开血腥序幕。接下来是英文会议的全部内容。如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
Welcome and thank you for standing by. I would like to inform all participants that this conference call, as well as any Q&A, may be recorded and made available to clients of JP Morgan. Where companies presenting any recording may also be posted on their website. Parts of this conference call may also be reproduced in JP Morgan research. If you have any objections, you may disconnect at this time. This call is intended for JP Morgan clients only. Press participants are not permitted on this call and should disconnect now. Unless otherwise permitted by internal JP Morgan policy, members of JP Morgan Investment and Corporate Banking are not permitted on this call and should disconnect now. At this time, all participants are in listen-only mode until the Q&A portion of the call. I would now like to turn the call over to Jose Asumendi.
Thank you very much. Jose Asumendi, head up the auto team based in London. Thanks for joining the Global Auto Call. And the topic of discussion today, we're going to be discussing tariffs, but also we're going to be looking at some of the fundamentals, including best ideas for 2025, as well as some of the previews we have been publishing in the first quarter. The call is going to last somewhere around 40 minutes, although we always are a little bit, we tend to extend. And it's an absolute pleasure to have all the speakers with us today, Nick Lai, on the China front, Akira Kishimoto heading up Japan Auto Research and Japan Research, Amin Pirani on the from India, Ryan Brickman on the US front, and Marcelo Mota, Brazil, commenting on Brazilian suppliers and Brazilian auto industry. We're going to go through the different regions, outlining some of the best ideas in the sector. And if you have questions, you can put your questions through the Q&A chat box, or you can raise your hand at the end of the call. But probably putting the call through the question through the chat box is probably the most efficient way. Look, setting a little bit the scene when it comes to tariffs, the Trump administration, President Trump, said some of the facts out there, and they clearly mentioned that in 1985, American-owned facilities in the U.S. manufactured 11 million cars, representing 97% of overall domestic production of cars. However, in 24, Americans bought around 60 million cars, SUVs and light trucks, and half of that were imports. And the point the administration is making is that of the other 8 million cars assembled in the US and not imported, the average domestic content is somewhere between 40 and 50%. So, conclusion, out of the 16 million cars bought by Americans, only a quarter or 25% of the vehicle content can be categorized as made in America. So look, we take it a step further, and when we think about, those 8 million units and where the units are coming from, we see about 40% coming from Mexico, about 20% from Japan, roughly another 20% nearly from Canada, nearly 15% from Korea, and then comes Germany and other regions, which account to less than 10% of those imports, right? So Germany, to put an example, is around 600,000 units, and Mexico is somewhere around 3 million cars. And why is this important? Just fleshing out a little bit more the relevance of Mexico here as a production country. We're looking at 3.9 million cars, I said 4 million cars, and internally, in excess of 1 million units goes to the internal market. The rest is being exported, right? This is basically where I think a lot of the discussions are being focused, not just imports of European cars into the US or from other regions. It's also that relation between US, Mexico and Canada. And when we think about Mexico as a production country, it's as big as Germany and South Korea. So it is, large manufacturing country. And if you look at globally, the next step down, let's say the 2 million car level, is Brazil and Spain. And you can find these production charts in our year ahead, 2025, which it came before the whole tariff discussion, but it puts into context which country is producing which vehicles and how much each of the countries are how many units are being exported from each of the regions, and sets, I think, a good scene into, or sets a little bit of a background to understand better the tariff discussion. The second point is the challenges, and frankly speaking, there are many challenges out there from a German OEM perspective. We've got like 3 or 4 premium brands, and each of them are importing a couple of 100,000 units into the US, and these are sedans. So they have many challenges because they are producing SUVs. Can you localize the production of sedans in the US? It's difficult because you don't have the economies of scale on sedans, and maybe the commonality on the architecture is just not the same as what you have on SUVs. Also, those engines and transmissions are coming from Europe. Okay, so let's say German OEMs decide to invest into local engine and transmission manufacturing assembly in the US. The business case of, okay, now we're going to depreciate these assets over the next 10 to 15 years doesn't quite work because you don't have the economies of scale, and then second, all of the regions are transitioning to electrification. So I think they're facing a multiple challenge of localizing production, localizing the content, and then also taking a view as to how are they operating on a 5 to 10 year view in the US when it comes to electrification. So one of the things we have, obviously I think will be interesting to see is the value chain of these car companies once they transition to electrification. And as the cars have less components, maybe there's also an opportunity to redesign the value chain of the auto industry in the US as these vehicles go electric. But those are some of the challenges. And what we hear from the companies is what they want to have is an understanding of what are the rules, what do they need to do, and then things will be done. Car companies, again, have depreciating cycles on assets that go beyond that 5-year term. It's more in the 10-year term. And I think setting that playing field is very, very important for car companies to be able to plan ahead. The impact on the auto industry, we quantified, so basically we've seen the 25% tariffs on car and light truck. We have seen the 25% duties also on part imports that will be launched from May the 3rd. We estimate for the European coverage around 25% hit, and we're seeing numbers between 13% on BMW, and maybe close to 20% on Mercedes-Benz and Volkswagen, 35% on Stellantis, and Volvo more than 70%. And the way we think about it is, if you're a premium car company, you're guiding somewhere between 6 and 8% margins. The impact on margins from tariffs could be a couple of percentage points, 2 percentage points. So that would take the 6% level to 4 on the lower end. And this does not include ramp-up costs, incremental fixed costs, helping the supplier base, compensating the supplier base, or any pricing mitigation measures the car companies may be able to take. When it comes to pricing, I think we will allow each analyst to take its own view, and I think Ryan has estimates on what is the impact on Ford and GM, and Akira has numbers as well on the Japanese. From my perspective, I think premium car companies, can they pass on price increases? Yes, of course. Anywhere Porsche Cayenne upwards, absolutely yes. Mass market, I think is quite difficult. I think it's very tactical. I think we need to understand first what are the terms and conditions of operating in the US in the coming years. And I think jumping into conclusions on passing on price increases in the US market, especially in the mass market, I just don't quite see it being implemented for the different European players. Although, some of them I think will definitely try when it comes to the mass market. The fourth point, what are the companies doing? We've seen Audi and Porsche providing some comments that they're considering setting up a plant in the US, investing into Rivian. Volkswagen has been putting an import fee to the stickers on its vehicles, and they've been halting some of the exports from Mexico. BMW provided some comments of increasing additional shifts at the Spartanburg plant. Mercedes-Benz is tactically considering maybe stopping some of the exports of compact class vehicles into the US, which will become very difficult to make money on. And Stellantis, we've seen a couple of weeks of production shutdowns across some of the plants, including Windsor. So the situation is volatile, and there are a few other elements I want to mention before I hand back to Nick. Thinking about the truck OEMs, my understanding, and things change obviously by the day, right? But we're not seeing those import tariffs for Class 8 trucks moving from Mexico into the US. Having said this, they will face some incremental costs from steel, aluminium, or some of the non-USMCA supplier content. So I think what we've seen so far is some comments from some of the truck companies saying that they could pass up to $4,000 price increases on those trucks to comply with incremental cost. So the truck OEMs should represent, in that sense, a safe haven. Having said this, the more we have these discussions, the longer these negotiations take, the more we impact one of the biggest earnings quarters in the year, the second quarter, and the order intake we're seeing across the truck OEMs in the US is pretty low, right? And this will impact Q2 result season. It will be difficult to make up for this lost ground in Q3, and we could end up basically postponing earnings momentum into Q1 2026. So that's one of the things that we always we end up battling with. Are we talking ourselves into a recession? Are we postponing earnings momentum into Q1 26? Is this a manageable situation? I think tariffs are manageable as long as we understand what is the playing field. But order intake in Q2, at least on what we see on trucks, is quite weak. The final 2 points I want to mention is asset disposals. On many of the fronts we've seen, Renault saying they're taking Nissan, is Forvia, which is one of the suppliers we cover, selling some of the assets, Mercedes-Benz selling they're taking damaged trucks. These are some of the elements we were considering in 2025. I think a lot of these asset disposals have been placed on hold, although we have seen a couple of things happening, like Traton increasing the free float, as well as Michelin selling some of the assets in North America as well. So, but again, on the bigger disposals, I think things are going to be still probably on hold until we walk into the second half of the year or 26, and we have more stability and clarity when it comes to the tariffs. We tend to get the question on in general on balance sheets and the FinCos. Are they well capitalized? Do we have the right net cash to sales ratios? The answer is yes to all of them. We just came out of the COVID stress test on FinCos nearly 4 years ago, right? So, and a lot of the management teams have been running these car companies were during COVID, around on COVID. So I think that the companies are well capitalized. I do worry about some of the suppliers. Ryan's got some of the suppliers that are quite levered. I've got Forvia running on nearly 2 times net debt to EBITDA, and some of the suppliers obviously will get hit by stop and go, by incremental cost, and that's where I think on the equity front we worry about some of those suppliers. So final point, how do we think about the safer basket? We wrote in a year ahead a basket of names that we think are safer when it comes to tariffs: Michelin, Renault, Volvo Truck, and Iveco. That this basket is I think there is no absolute safe haven, but I think these are the names that I think are safer. And then who is going to get more impacted with the impacted? That's, I think, that the market will I think we will gain clarity, car company by car company, OEM by OEM, depending on how things work out between Europe, US, and Mexico, Canada, US. So we will see how things work out. Final point, fundamentally, I'll keep it super brief. Look, I think we should keep an eye on fundamentals. The start of the result season is good. If you take out the tariffs, global car production is growing slightly. Pricing power, I think, is good in the US, is stabilizing in China. We're seeing about 6 to 7% margins for the premium car companies. We're seeing signals of stabilization for the premium car demand in China. And if we exclude the tariffs, 2025 would be a pretty solid year across most of the OEMs out there. With this, handing back to Nick to comment on some of the topics around China and best ideas. Thank you, Nick.
Yes, thanks, Jose. This is Nick calling from China. I cover auto sector here in China. Well, I think first of all, the U.S. tariff implication or impact in China, the first order impact is essentially zero or almost very limited. The reason because in Trump's first term back in 2018, Trump has already imposed 25% tariff on many Chinese goods, including car. So back in 2018, ever since 2018, Chinese car maker has actually stopped exporting any car to the U.S. to the U.S. And prior to that, very few have had exposure anyway. Like BYD, prior to 2018, BYD exported only a few hundred of EV bus. But right now, at the moment, no Chinese car maker has any direct exposure to the U.S. market. So the first order impact is essentially very limited. But of course, at the same time, if you look at the share price performance, let's say back in 2018, when Trump first announced the 25% tariff on Chinese car export, the auto sector had seen P/multiple pulling back or falling by about 20% in the first 2 months, and then we rebounded. But this time, the economic cycle is very different. I think this time around, the impact on Chinese car maker will be coming more from second order impact, i.e. if global economy or auto sales volume is slowing down, that will have an impact on Chinese car export. Because bear in mind, China export a record volume of nearly 6 million cars last year. And based on our current published view, the total car export volume can potentially top another record level, somewhere about 6.5 million units. At the moment, the first quarter run rate is up by 7 to 8% year on year. So we'll watch very closely. But at the same time, if we look at the key export market, the number one market is Russia, accounting for nearly a quarter of China's car export, followed by Latin America and Middle East and Africa. The free market, Russia, Latin America, Middle East, and Africa altogether accounted for 58% of China's car export last year, then followed by Europe, another 15%. So we'll be watching very closely whether there's any slowdown of the car export volume in this market. But at the same time, we are also mindful that key car makers like a BYD, they are not only exporting the car, but they are also building capacity outside China in Latin America, Southeast Asia, and Eastern Europe. So we'll be watching very closely on that. Lastly, in recent first quarter result, we saw the car maker like BYD beating expectation, and we remain BYD top pick in China auto space, and its annual volume is about 6 million units a day, and we do expect BYD's total volume globally can potentially hit 9 to 10 million units by 2030. Basically, limited impact on China. Let me take a pause here and hand over to Akira-san on Japan.
Thank you, Nick. Good morning, good afternoon, everyone. I'm Akira Kishimoto, covering Japan autos and auto parts. From the Japan auto sector standpoint, of course, there might be kind of some no small impact for the major OEM through the tariff impact, but we still have a kind of a more kind of constructive view. And we should have more kind of be selective in terms of the stock pick within the OEM. First of all, regarding the tariff impact for the major Japanese OEM, so basically a Japanese OEM has roughly 55% US local production ratio. So in other words, 45% is imported from Japan, Canada, and Mexico. So of course, 25% tariff will be imposed from Japan imported vehicles. And also some of the kind of impact should be expected as well from Canada and Mexico vehicles. But regarding the large cap name like Toyota and Honda, especially Honda is one of the highest local production ratio with around 80% in the US. And also for the rest of the imported vehicle, mainly comes from Canada. And the US content ratio of the Hondas produced in Canada is around 60%. So the realistic kind of tariff imported from Canada is only 15%, not 25%. And also the similar situation will be expected for the Toyota. So according, if we try to calculate the kind of the impact from the tariff, including the kind of tariff adjustment from Canada and Mexico, well, we expect around 35% the negative impact the Toyota and roughly 30% for Honda, respectively. But the for the major the other OEM like Nissan, Mazda, who has kind of large exposure from the imported vehicles from Mexico and from Japan, their impact will be almost 100% or even more. So we might be kind of more selective, and we think that Toyota and Honda will have a kind of relatively the manageable impact for the tariff impact. And also, we have to see which company or which brand has a kind of capability to mitigate the kind of a negative impact of tariff. I think as already the host mentioned, I also believe that the major Japanese OEM will try to raise price for the kind of reducing the incentive to adjust the kind of transaction price. So there is some kind of news flow that they will never raise price. I don't think so. They are trying to adjust the kind of the transaction price going forward. So, for example, for Toyota, out of the total gross impact of the 30% of the profit, 1/3 might be kind of pricing actions, 1/3 will be kind of cost sharing with the supplier, dealers, and other supply chain. And roughly the rest of 1/3 might be kind of pure negative impact from the tariff. So in that cases, kind of net the impact from the tariff might be roughly 10 to 15%. So in that case, I think that Toyota and Honda will be able to manage the overall impact by adjusting the kind of production flow or the kind of maximizing the business for the other region or etc. So we'll still have the relatively constructive view of large cap name, especially for Toyota. I think that people in Japan, we are entering into the fiscal year end earnings. So the investors seem to be kind of sensitive for the new year guidance. I think even Toyota will guide, let's say, around 3 trillion yen are the profit guidance at the initial stage. I think this is a kind of real, the bottom or the last negative news flow that we confirm. So if we are able to confirm with the kind of a gradual market share gain in the US driven by the kind of very robust hybrid demand, I think it should be a kind of a good entry timing to buy on weakness. So within the OEM, we'll still have the bullish view on Toyota as a kind of top pick within the Japanese OEM. And moving to the auto parts, most of the parts maker also have the vast amount of the export and the value from Japan to U.S. market. So let's say, for example, with Denso or Aishin, we also think that the 20 to 30% growth negative impact from the tariff. So the kind of point is if the parts maker will be able to pass through to the OEM, or is there any kind of a price pressure from the OEM as well? I think it's they will be able to pass through the kind of cost inflation to some extent. But I think this is only with the business condition within the Toyota. But also the old suppliers will have a kind of a structural headwind with China. So even including the kind of U.S. tariff impact, as well as the kind of structural the difficulties in China business, we still have a relatively positive view on OEM at this point. And lastly, for the tire space, the Bridgestone has a relatively larger exposure for the local production ratio with around 70 to 75%. So when people assume that the 25% the tariff will also be imposed for the imported tire, that will be kind of relatively positive on the Bridgestone, who has one of the largest U.S. local production ratio within the Japanese tire makers. That will be kind of less negative in terms of the price competition with the cheaper imported tires. So we still have a kind of bullish view on the tire name as well. And also heading into the fiscal year end, our stock recommendation of the best idea within the Japanese auto parts and tire is Toyota as the top recommendation within large cap name. Also, we still have the constructive view on the truck name, which is Isuzu Motors, who has a kind of large profit contribution from the aftermarket the product. Also, within the parts makers, we have a relatively the bullish stance on the Toyota Industries with the kind of meaningful profit contribution from the global forklift the business, as well as the kind of e-compressor contribution as well. And lastly, from tire space, as I pointed out, the Bridgestone is one of our top the recommendation within the tire space, within the highest profit contribution from the U.S. with the kind of highest local production ratio as well. Let me pause here and from my side, and let me hand over to Amin from Indian Autos.
Kishimoto-san. This is Amin Pirani. I cover the Indian auto and auto component space. As far as the U.S. auto and component tariffs are concerned, the big impact is on the auto components space in India, because if I look at, the large investable names, approximately anywhere between 20 to 50% of revenues are derived directly or indirectly from the U.S. automotive industry for a lot of Indian auto component suppliers. Within our coverage, we have Apollo Tires, where the impact is very minimal because the U.S. exposure is very low. But among the three large other names, which is Samvardhana Motherson, Bharat Forge, and Sona Comstar, the revenue contribution from the US is anywhere between 20 to 40%. And hence, the impact it can be quite a lot. But here also there are some nuances. When I look at Samvardhana Motherson, which is like a $9 to $10 billion market cap company, most of the US exposure is from facilities that they have in the US. So for them, the import content into the US is quite low. Around 20% of revenues are derived from the US, but most of their plants are in the US. There is some supply chain coming in from Mexico and other parts. But there again, the benefit is that because most of the things that they make in the US are wiring harness, and copper, which is one of the main ingredients, is not currently, unlike steel and aluminum, has been exempt for now. But at the same time, they have some indirect exposure because Europe is around 40 to 45% of revenues. And as Jose mentioned, European luxury car guys also export into the US. So there can be some indirect impact for Motherson there as well, because Mercedes, BMW, Audi, Porsche are the main customers for Motherson. If I look at Bharat Forge, they supply mostly into the US Class 8 trucks, as well as some mining and other equipment into the US. Most of it is exports, unlike Motherson, so the impact is higher. And when I look at Sona Comstar, they supply a lot of differential gears and differential assembly into a lot of EV companies into the US again. So that is also something which is going to be under a lot of stress. We estimate right now that the earnings impact could be anywhere between 10 to 30% on the lower side for Motherson, which has direct plants into the US, and on the higher side, 20 to 30% for companies like Bharat Forge and Sona, which are exporting from India into the US mainly. But I think eventually, the impact will be a function of whether these companies can pass on the tariffs to their eventual customers, or even if they're able to pass it on and pricing is increased, what happens to demand in the US eventually, because a lower demand scenario in the US, over the longer term, obviously is a bad thing for suppliers. Moving on to the OEMs, the only OEM within our coverage which has a significant exposure to the US is Tata Motors. Currently, our ratings are suspended on the name, but based on factual information, what we can highlight is that Jaguar Land Rover is around 65 to 70% of the earnings for Tata Motors. And for Jaguar Land Rover, the US is around 30% of volumes. And most of their bigger luxury SUVs are sold in the US. And hence, the impact can be quite high. Jaguar Land Rover currently has no operations to manufacture in the US. All of it is exported entirely either from the UK or from their facilities in Slovakia. So obviously they will be, subject to the tariffs. And based on the announcement recently, they are, taking some small shutdowns in April before they get a final sense as to how these things will go on. But given that they are in the luxury space, I think most likely there will be, some price hikes that they might take, but we'll have to wait and see. The good thing about the suppliers that I mentioned is that most of them have very low leverage. All three of them, in fact, raised equity last year when the India market was quite hot. So for Bharat Forge and for Motherson, the net debt to EBITDA is just about 1x. For Sona, actually, they are a net cash company. And Motherson specifically, we have seen in the last 15 to 20 years have actually grown by acquiring smaller suppliers in times of crisis. So, it would not be a surprise that Motherson would be on the lookout for such opportunities, given their low leverage and given that they have a very well-diversified global footprint. And within our component company space, that would be our preferred pick. Going on to the OEMs, India-focused companies which are not impacted by, this tariff business, the companies that we like are Mahindra and Mahindra, which is into SUVs and tractors in India. Both those businesses are doing quite well for them. The other company that we like is Eicher Motors, which has the Royal Enfield motorcycle brand, which is also seeing a very sharp recovery. And more than 90% of volumes are derived from India. So these are the things that we like. I would now, pass it on to Ryan. Over to you.
Hi, thanks. From the U.S. Autos perspective on these tariffs, of course, our coverage space is really at the center of the storm, with GM and Ford deriving essentially 100% of their profits from North America, and with the average supplier generating roughly 40% of their revenue and likely a similar proportion of their profits also from the region. So as we've said from the beginning, these, back when the 25% tariffs initially on autos and auto parts, or everything really from Canada and Mexico, was announced back in February, seldom do executives even refer to the U.S. auto industry, right? It's always just the North American auto industry. The United States has had free trade with Canada on autos and auto parts since 1965, when Lyndon Johnson was president, and with both Canada and Mexico since 1994. early on in the Clinton administration. So Jose and I visited one company, Finia, on our trip to Detroit in December that told us that some of their fuel injection parts actually travel back and forth across the Mexican border up to 7 times, for various parts to be installed before they're ultimately, finally imported into the U.S. So the supply chain is just really incredibly intermeshed, and these tariffs do threaten to upend the industry. So looking at, some of the different ways that they could impact our coverage, starting first with, the industry as a whole, and then maybe drilling down to the automakers, which I estimate will be the biggest losers, followed by the suppliers, and then can finish too with actually who in our coverage might even benefit. It's a small subset, maybe just 3 or 4 stocks out of the 35 plus we cover, but I do see some beneficiaries. So for the industry as a whole, according to U.S. government data, approximately $244 billion of finished light vehicles were imported in the U.S. from all countries in 2024, $110 billion of which came from Canada and Mexico. Presuming that 1/3 of the component or raw material value of USMCA compliant vehicles made in Mexico or Canada is sourced from the United States, then that $110 billion can be reduced by 33%. So 72 billion vehicles come in, or tariffable amount, I guess, come from Canada and Mexico, and then you've got the rest of the world, which is $134 billion. So it still comes to like $234 billion. You're looking at potentially a $51.5 billion bill there, assuming a 25% tariff rate. Then you've got the auto parts. The government reports the U.S. having imported 197 billion of parts in 2024, 101 billion of which came from Canada and Mexico. So going through the same exercise, deducting 33% of U.S. sourced subcomponents within those components or raw material value, you'd get 66 billion tariffable coming from Mexico and Canada, and 96 billion from the rest of the world. So there you got 162 billion times 25%. I will say that we don't quite use 162, we use 122 because we're not sure how many of the components will actually be tariffed. Certain components will be and certain ones won't. The automakers are trying to get more exempted, but assuming that 75% are subject to the tariff, that's 122 billion times 25%. So 30.5 billion on the parts. You add that to the 51.5 billion we talked about for the vehicles. There's your industry total bill of $82 billion. This high-level math should be pretty accurate, and President Trump did sort of throw out a $100 billion potential revenue raise on the back of these tariffs. So it's probably ballpark. But where the analysis becomes a lot trickier, of course, is estimating, how this big burden is going to be shared amongst the various different industry participants, including automakers, part suppliers, dealers, and consumers. So we've published already, 2 high-level scenarios for illustrative purposes. One in which all the costs are absorbed by automakers, and one in which the automakers are successful in passing all those costs on to customers. And to be clear, in the latter scenario, which would be far preferable from an automaker perspective, they still don't get off free. I mean, because of all the demand destruction that they're going to create as a result of those price increases. So, but looking at the first scenario, if we look at GM's operations in 2024 pro forma, so they're not to attempt to raise the prices or change anything else about their operations, but just simply paying the tax. We calculate actually, and we've showed these calculations, that it can cost them up to $10.5 billion on the finished vehicles, $2.5 billion on the parts. It's $13 billion total, or roughly 88% of the $14.2 billion midpoint of their 2024 EBIT guidance. Now, Ford is in a somewhat better position. Still bad, but they're expected to pay only $2 billion on the finished vehicle imports. That's because they only import about 15% of their vehicles that they sell in the U.S. GM's closer to 45%, but they're in the same boat as GM on the parts, about 2.5 billion, we think. So a total bill for Ford, 4.5 billion, or 58% of their $7.75 billion midpoint EBIT guidance. Now, let's look at what happened, though, if they could pass all those costs on to the consumer. So if you divide that $82 billion industry bill we talked about by the 16 million vehicles sold in the U.S. last year, it comes to $5,125 per vehicle. Dividing that into last year's $44,800 average selling price, it's 11% inflation on new vehicles. But given the consumer is already tapped out, right? I mean, they're stretched. New vehicle prices have risen 28% since the start of the pandemic versus overall CPI 22%. And with the rise in rates, monthly payments are up closer to 40%. We feel it's just imprudent to model anything other than an elasticity of demand of 1 here. So implying that, an 11% increase in price will give you an 11% decline in volume. It could even be more as consumers wait for the price to come back down potentially. So SAR would fall in that scenario from 16 million last year to 14.2, which is, pretty low. But, remembering in the first scenario in which automakers, they did not pass on the tariff costs, right? So their revenue would remain the same, their cost would go up, and the EBIT down precisely by the tariff amount. In this second scenario, though, in which all the tariff costs are passed along, so the automaker revenue and cost would increase by the extent of the tariffs, but the revenue would also go down by the extent of the tariffs, given the demand destruction. Although they can, in that case, remove the variable costs associated with that lower volume. So assuming a typical automaker volume-driven operating leverage of 40%, we calculate that if all tariff costs are passed on to customers, they would essentially lose 40% of the tariff cost, right? So GM's EBIT in this case would fall by $5 billion or 37%, and Ford's by $2 billion or 23%. Our base case scenario averages the two approaches. So assuming one half the costs are passed on to consumers and one half are absorbed by automakers. So, the new vehicle prices go up by 5.5%. SAR goes down by 5.5% from 16 million to 15.1. In that case, GM's EBIT falls 63% and Ford's by 40%. Now, that's what we know about tariffs today. Ford reported to us last week that they're continuing to negotiate with the Trump administration, and that they expect the final rules to be revised on May 3rd. They are arguing for more USMCA compliant components to be exempt from the tariffs, and relate that the industry is pressing also for various other costs such as R&D and even the apportionment of certain operating expenses, to be excluded from the tariffable value of finished vehicles, potentially saving GM and Ford maybe a couple $2 billion more versus what we talked about. I will say, I think the administration's rollback of the reciprocal tariffs announced last week and the temporary exemption on certain electronics coming from China over the weekend, it's a positive sign that the rules could grow less draconian, although autos were not included in that rollback, unfortunately. Now, with Tesla and Rivian, they've got some parts exposure, but they're by far the least exposed from a cost perspective because all of the vehicles that they sell in the U.S. are manufactured domestically. Ferrari's exposure, it sits in between the EV companies on the one hand and GM and Ford on the other. They have no parts exposure, but they do export 40% of their vehicles to the U.S., which is their largest market. Ferrari does stand out, though, because of their 50% gross margin versus traditional automakers' 15%. Because automakers are tariffed only on the cost of the vehicle across the border, not the marked up wholesale price, which includes your gross profit, this reduces Ferrari's exposure by 70% compared to traditional automakers, 15 into 50, right? Which can nearly, be offset by that 10% price increase that they announced the day after the tariff. So they're impacted, but also I would say, but sitting pretty. Also, I would say the elasticity of demand there is a lot different. When they increased prices 7% in the UK after Brexit, they didn't even see a decline in demand. And if they did see a decline in demand in the US, they could, they've got a 3-year wait list globally. They could just shift more of that volume to other regions. So very differentiated. Now, for suppliers, we assume automakers will reimburse them for any direct tariff costs, which some automakers have already set up mechanisms to do. They could still face a modest margin loss, though, as a result of automakers likely being more reticent to reimburse them for any indirect costs incurred by their tier 2 or 3 suppliers. The bigger threat, though, to suppliers, I think, is from the demand destruction. So the more successful automakers are in passing costs along to consumers, the bigger the impact on suppliers. If North America production falls 5% on the back of a 5% new vehicle price increase, then the typical supplier with 40% revenue exposure to North America and assuming 25% decremental margin and 10% base margin rate, they'd stand to lose 5% of their global profits. Suppliers are much better positioned than GM and Ford because they make money around the globe versus GM and Ford, which really rely upon the impacted North America region for 100% of their profits. Now, this is the impact of suppliers from only the demand destruction from higher prices directly as a result of the tariffs. It does not take into account the potential impact to the economy from tariffs on all types of goods, including non-autos, which JP Morgan research has indicated could push the U.S. into a recession, which is the last thing we need on top of the demand destruction from higher prices. Past recessions have historically averaged a 23% peak to trough decline in sales. Assuming a 28% decline in sales from both higher prices and a recession, the average supplier could lose 30% of their global profits. And that assumes that other markets are unaffected. Right? So not a great scenario, but it's worth noting that even in a recessionary scenario, it's still a better outcome for suppliers than the tariff scenario alone for automakers without a recession. Okay, I want to say too that, even if suppliers are initially reimbursed from customers for their tariff costs, they likely won't be when those contracts come up for renewal, implying future capital costs should the tariffs prove long lasting as they need to move their production base. Finally, let me wrap up on who can benefit. As mentioned earlier, it's a short list, but I would point out the rental car companies first and foremost, given that they are in part leveraged plays on used vehicle values. Remember that when Hertz went bankrupt early in the pandemic in May 2020, its stock was at 24 cents. Its bonds were trading at 30 cents on the dollar. But they had $10 billion of vehicles on their balance sheet, which, because of the semiconductor chip shortage, as well as the pandemic, according to the Manheim Index, rose by 70% in value, 70%, leading to not only full recoveries for the creditors, but also the shareholders receiving the equivalent of $19 in new equity, or 80 times higher than the 24 cents the stock bottomed at. We're not calling for anything that extreme, of course, but today's, Hertz's market cap is $1 billion. They own $12 billion of vehicles. Avis's market cap is $2 billion. They own $15 billion of vehicles. So, if used vehicle prices, they typically move 2 times the change in new prices. So, doubtless rental operations will suffer from less corporate leisure travel as the economy slows, et cetera. But if in our base case scenario that used vehicle prices rise, or new vehicle prices rise by 5.5%, so used vehicle prices could rise by 11%. So the increase in, 11% of Hertz's $10 billion fleet and Avis's $15 billion fleet, or, Hertz's $12 billion fleet, sorry, that's equivalent to like 120% of Hertz's cap and 80% of Avis's cap. So those are probably the number one winners here. But I would also highlight Copart, which is covered by Jash Patwa on my team. It was another pandemic era winner. I covered it during the chip shortage. I mean, basically what they do is they take a fixed percentage cut of the vehicles, the wrecked vehicles that they sell on consignment from insurance companies at auction, and wrecked vehicle prices are determined by used vehicle prices, because a lot of them are like exported overseas where they're reconditioned for retail sale, and scrap commodity prices. And, with the tariffs on steel and aluminum increasing the spot rates in the U.S., as well as with the tariff cost increase in new and by association used prices, this is an increase in their revenue that converts into EBIT at 100%. I mean, it doesn't cost them anything to just collect more of the gross transaction value, a similar percentage of the gross transaction value. So I'd highlight Avis, Hertz, Avis being safer there because they're less levered. I mean, you want leverage to benefit from this, but also, Hertz is on a little bit less firm ground than Avis, in the event that this doesn't play out like we think. And then Copart. So those are the stocks to kind of hide out in. I think that GM and Ford are a little bit uninvestable, to be honest, until we find out what's going on exactly on May 3rd. Ford, by the way, moved its earnings from before May 3rd to after May 3rd. For that reason. And then within automakers, it's definitely Ferrari is going to be the place to hide out. With that, I'll pass it on.
Thank you, Ryan. So good morning, good afternoon, everyone. I'm Marcelo Mota. I'm responsible for the coverage of the Latin auto part companies. Most of the companies under our coverage are represented by auto supplier. And as Ryan mentioned, the companies do have contracts that allow the pass-through of higher tariffs or new tariffs to the OEMs, which was something that they learned during COVID and all the pain that was caused by higher energy price, FX volatility. So now the companies in Latin, especially in Brazil, they do have more robust contracts than they have in the past, which, looking at the glass half full, will help them to mitigate the impact of potential tariffs. However, if we look at the glass half empty, if there is higher auto prices and lower demand, lower volumes, there will be lower operational leverage. So we do see that the companies, they are in a relative better position than OEMs, but they are not safe, right? For some of the companies that we cover, the U.S. represents up to 30% of their revenues. Sometimes they don't have production inside the USMCA, which might help to alleviate the impact of the tariffs. So when we look at our coverage, the companies that are mostly exposed to the U.S. and could be impacted are Yoshpi Maxion and Tupy. Yoshpi Maxion, they do wheels, and Tupy, they do engine blocks for heavy vehicles. So in the case of Yoshpi Maxion, we believe that the impact on top line could be up to 6%, as the U.S. represents 30% of of revenues, and 85% of what they sell in the U.S. is not produced internally. However, it is produced in Mexico. And, if the USMCA doesn't have the tariffs, that could be a reason for Yoshpi to recover. But I would say most of the investors in LATAM, they are considering that there will be some taxes and that it will impact the company. And for Tupy, the company generates almost 25% of its revenues in the U.S. and 100% of that is produced in Brazil today. So the impact that we calculated is around 3.5% on top line. However, Tupy is exposed to heavy vehicles, which in our view will have a lower elasticity to higher price since they are a capital goods component. And they do have a plant in Mexico, which they are not using that much nowadays because of efficiency. But they say that they can move some production lines to Mexico from Brazil if the tariffs are hurting the margins here in Brazil. So then going to the companies that will be least impacted, those are Randon and Marco Polo. And Randon does road equipment, trailers, semi-trailers, and most of it is domestic market. And Marco Polo, they do bus bodies, again, mostly domestic market. In LATAM, they have zero exposure to the U.S. market. So those are the companies that we would hide in this auto parts segment in Brazil. So we are getting to the final 10 minutes. So I'll stop here to see if anyone has a question.
Operator, can you open the Q&A box, or if anyone has a question, maybe you can just raise your hand if any questions are there. Thank you.
Yeah, so just to break the ice, let me do the first one to Jose and Ryan. During COVID, we saw the OEMs focusing more on the premium vehicles, which have lower elasticity. There was a semiconductors shortage. So actually, in the end, kind of the crisis were good for them, like with a lot of parentheses here. But could we face some similarities now? There are tariffs, so just the Ferraris, just like the very nice and expensive cars, how to think about it?
Yeah, I have thought about that, and unfortunately, I don't think that the analogy applies well. I think that in this case, the higher prices, GM and Ford, they were able to raise their revenue, but their costs reset at a slower rate relative to when they were raising the revenue, because they only renegotiate the UAW every 3 years. It takes DNA 10 years to reset. They're paying the suppliers a higher price on a lag. In this case, their costs increase immediately. Right. So I actually think that the cost increases are going to precede the price increases and be more than them. So it's an interesting comparison, but unfortunately, I think it doesn't apply. And this is a bad thing for automakers. And then also embedded in your question is about kind of like the mix up that we saw to richer levels of the mix. We are definitely going to see that. Jose, I'd like to hear what he has to say about, I've seen these articles about Mercedes. They just might not sell the GLA anymore. And when we were on his trip to Munich recently, I think BMW said, or was it Mercedes said, they make like 80% of their profits on 40% of their vehicles, something like that. So same thing, I think, with GM and Ford. Like GM is making these Chevrolet Trax, Buick Envista in Korea, Chevrolet Trailblazer, importing this stuff. They're really hot. They're like $23,000 vehicle. Everyone wants them, but they don't make 25% margin. They don't make close. They make some of the thinnest margins on those cheap vehicles. So they might just stop importing those. Ford told us that they don't make money on any Mach-E that they make in Mexico today. They lose money on every single one. They have a negative gross profit contribution margin. You add 25% cost to that, and they said in a dinner we did with them in December last year, they said, we'll just stop making it, especially if Trump rolls back the EV. So I think that vehicles are going to become less affordable. The cheaper vehicles are going to disappear. And the way that people talk about housing being unaffordable in the U.S., they're going to be increasingly talking about that for autos now too, for the middle class.
Bartholo, it's a really good question. So I think it was one of these things, questions that don't come prepared. This is one of them, by the way. Look, when we think about, the last time COVID, it was basically, I remember upgrading BMW, I think it was like March, at the thick of COVID, really. Like I was doing a Zoom call from home, upgrading BMW to overweight, and people were looking at me like, what are you doing? I'm like, yes, BMW volumes are going to come back. And I remember at the time, we had done, a call with the BMW China CEO, and he was pretty clear that volumes were coming back in China, clearly. And this was March, April when things were pretty bad during COVID time. So the advantage we had at the time is that we saw clearly that China was coming through, that premium car demand was rebounding. And since then we had a big lessons learned, which is inventories are kept low, pricing power strong. So every time I look at the market data globally, across many of the regions, I actually see very robust pricing power, right? And I think when I look at Europe, pricing power is more stable than what it was last year. We have taken out the pressure to sell electric vehicles in the market because car companies can meet emission targets not now in 25. They can do it over a couple of years. So there's no need to push for electric vehicles. Pricing power is good. So to your question, there's some analogies there. So we've done the stress test on balance sheets. We are running 10-15% net cash to sales on industrial companies. The Fincos have proved already in 2008 and during COVID that the Fincos are running very well capitalized and they have very well diversified funding sources. But, never say never. And every year when we look at the auto sector, I think what is going to surprise me? And can we create another potential recession where there are underlying patterns we have never seen, and this is one of them. We're talking ourselves into a recession, potentially in the biggest earnings quarter, which is Q2. And I have to retool the industrial footprint of some of the companies to reset how they do business in North America, when at the same time, Chinese car companies are raising basically $6 billion to, Nick's like coverage, continues to basically to take on market share. Nick can comment on what the Chinese have been doing to raise capital in the last 3 months. So China is just executing, taking market share. And the rest of the world is basically trying to figure out how we do business in Mexico, US, and Canada, and Europe, US. Fantastic, So there are definitely analogies when we think about it. If we go into recession, it is definitely not priced in. According to, our latest published research, there will be more downside from current levels. But, I think one of the elements that we continue to stick to in the auto sector is unemployment ratios. If unemployment ratios basically stay relatively low, then, car demand will continue to remain strong. If unemployment ratios shoot through the roof, that's how always has been the leading indicator to forecast the rapid decline in car sales across any region. Thank you, Marcelo. Thanks for the question. Nick, maybe can you comment a bit on execution of Chinese OEMs? I think, when you look at the global auto sector, this is one of the elements that is just incredible, right? We are all here discussing tariffs, and Chinese OEMs are going to the Shanghai Auto Show, launching new vehicles and executing.
Yeah, true. Well, I guess, again, tariff is at the moment not relevant to China on the first order. I guess this year is probably an important milestone where business model for key car maker like a BYD is shifting from a pure exporter in the past to more and more localized solution, i.e. BYD just finished its capacity of factory in Thailand in second half last year. And by year end, for instance, again, BYD's factory in Latin America, Indonesia, and presumably Eastern Europe, like Turkey and Hungary will all be completed. So you'll see a new wave of localized capacity from company like a BYD and Geely or Great Wall Motor coming in the next, say, 12 months or so. And at the moment, you can see Chinese car maker, they are very much technically targeting only, let's say, two markets. One is the market with no homegrown national brand. They are Latin America and Southeast Asia. These markets are very much Japanese and American OEM. And secondly, they are also targeting the market where there are local supply chain where they can leverage, like Thailand, Eastern Europe, and so on. And so they can leverage the supplier and build the volume from there. So again, interesting. Last year China exported totally nearly 6 million cars, and first quarter run rate is so far on track. We currently published view is China can export altogether somewhere around 6.5 million units. So I think whether they can deliver that or potentially being affected by global economic slowdown, we'll watch very closely on very much a few markets, Southeast Asia, Latin America, and maybe Russia, and also very important, increasingly more and more important in European market.
Akira, from the Japanese OEMs, which one is the most at risk from basically exporting too many units into the US, not having enough local production?
Yeah, thank you, Jose. So from the Japanese OEM standpoint, the major tier 2 OEM, including the Mazda, Subarus, and also the Nissan, unfortunately, has a relatively low US localization rate with the roughly 50%. And also regarding the Mazda, their US local production rate ratio is only 25%. They originally doesn't have any kind of US local production at the site. Recently, they launched the kind of the joint, the plan with Toyota, but still, this is this one. So the Mazda, the lower the local production ratio, as well as the kind of lot of the exposure from the imported vehicle to Mexico and Japan, with a really low US local content ratio, let's say around 10%. So the Mazda will not be able to have the kind of beneficiary of the kind of reducing the realistic tariff impact. So according to our calculations, the Mazda's the profit will likely to be gone, or the gross negative impact from the tariff is much bigger than that of the annualized profit. So for the tier 2 OEM, especially Mazda and Subaru, will have a kind of meaningful negative impact. So we would like to see how they can mitigate the kind of negative impact by raising price. Also, kind of a more kind of close relationship or the alliance with the Toyota, etc. So from the Toyota standpoint, one of the only risk is if they have to kind of rescue these kind of tier 2, that will be a kind of tail risk in my opinion. Thank you.
We've got a bit of a shy audience today. I think the larger the group, the less the question. Sometimes it happens. Ryan, maybe last point. May 4th, I think you mentioned, I hear you, like, I think that's basically the D-Day now, the next sort of important day to in the calendar when we think about the next developments for the car companies. The problem that I have is that, until then, we still have another 2-3 weeks, and that's not good news for the auto sector, truck sector. Basically, we end up losing orders, sales, momentum. We're hitting one of the largest months in the second quarter, being the second quarter one of the largest earnings generative quarters in the year. What are your expectations for this day, and what do you think will be the potential outcome?
Yeah, I'd always had it on my radar screen that we're going to learn more on May 3rd about the Annex 1 to the executive order, presidential proclamation, in terms of exactly what vehicle parts are going to be continue to be exempt so long as they're complying with USMCA from the tariffs. But what I didn't know was that they're still negotiating on the tariffs that have been in place since April 3rd, the 25% sectoral tariffs. And a couple of things that they specifically mentioned to me was that they're looking to get research and development expenses removed from the cost or value of the vehicle. So, I was looking at this last night. GM spent like $9.2 billion on R&D last year, and 77% of their consolidated deliveries were in North America, 63% in the US. So that could actually reduce the tariffable amount for GM by $5 or $6 billion, and then you multiply that by 25%. It could be very substantial. And then in addition to R&D, and like Tesla, they show R&D as an operating expense, but most traditional automakers, they show it as part of COGS. But then they were also thinking we could potentially reduce the value of the tariffable amount by some expenses that aren't even in that amount. Like, but we spend a lot of money on advertising and that helps, this company or that company, or just various different things that could cause the tariffs to grow less draconian. And, they really are very punitive for domestic producers, ironically. You wouldn't think to do something like that unless you gave people more of like a heads up time or something. So the tariffs are very bad right now, and they're not going to get any worse, I think, and they have the potential to get better. Ford even told me, I doubt they'd want me to be repeating this, but they said there's even, like in the Detroit News, an executive was quoted as saying, there are 3 scenarios we're looking at. Okay, bad, and Armageddon. Okay. So right now we're kind of like veering between the bad and the Armageddon, but there are some potentially better scenarios, possibly, like, for example, if they say, okay, fine, all parts are excluded, so long as they're USMCA compliant, like we're not even going to do it on all those parts. I mean, that would be great. And Ford says, in a scenario like that, when you take in the price increases and then some changes to our operations where we build the vehicles, et cetera, if we're not paying on the parts, then maybe we could even benefit. And to me, that sounds kind of wild. And certainly GM under no scenario could benefit just because of how much they're paying on the finished vehicles. But so yeah, I think that, and I don't know, but I think that it is going to get better than it is now. But it is, it's not going to get worse, but it's still going to remain bad.
Brilliant. The situation remains very interesting, highly volatile. I think we'll have to repeat this call at some point in the coming weeks. I don't see any additional questions. Thank you so much, everyone, for joining. Much appreciated. Learn a ton for the rest of the participants. And thank you very much. Thanks so much.
Thank you.